Welcome to the PJ Finance Show.
Today we will discuss a framework for country investment, Part 4. I can't believe it, Phoebe. It's 6 a.m. on a Sunday. Why are you awake?
Planning to treat you to a nice breakfast. What else?
Need help again?
Unfortunately, yeah, and I feel bad to seek your help so frequently.
Don't worry about it. It is just money and you have plenty. I am always good when it comes to getting a nice big meal.
Now that I know about country investment, I would like to know if higher growth rate means better economy, in a sustainable sense.
Easy. Let me offer my help for free this time, and if you like, breakfast is on me.
Wow. Thanks in advance.
See you at McDonald's. I have a coupon. Buy one get one free.
Really? And you are a portfolio manager? Oh well, nobody is perfect.
When we look at this chart, it is shown that the average real GDP from the 1970 to 2015 is 2.8%.
However, if we look at the period between 2010 and 2020, the average real GDP is 2.3%. Is the growth rate too slow or too fast?
Good question. We need to judge from the trend growth rate, or more accurately, the potential GDP growth rate. The real growth rate of a country will fluctuate around the growth trend rate. The United States, for example, is increasing at about a 2% trend rate. When real growth exceeds the growth trend rate, the economy displays a positive output gap, like Area A.
This makes sense because every country has limited resources, and this can be measured in terms of unemployment rate and factory capacity utilization rate.
Yes. When there is a positive output gap, the economy is growing faster than the sustainable rate. For example, when there is too much demand for workers, the unemployment rate falls below the NAIRU.
NAIRU is non-accelerating inflation rate of unemployment. The NAIRU is the lowest unemployment rate that can be sustained without causing wages growth and inflation to rise. It is a concept that helps us gauge how much spare capacity there is in the economy.
When companies pay more wages for workers, unit labor costs would likely rise, and profit margin would likely decline.
That must be bad for the equity market.
Absolutely. And for the bond market, since there is more inflation, the interest rate will go up and the bond market will sell off. Conversely, when the economy grows slower than the trend rate, we have a negative output gap and a recession.
I know that the Congressional Budget Office (CBO's) estimate of potential growth rate is widely followed by economists and investors. But why did it revise the growth rate from roughly 3.5% to about 2%?
Firstly, you need to know potential GDP growth rate is related to labor force growth and productivity growth.
Note that we are referring to year-on-year growth rate, not absolute levels. A country with a very large labor force and a very high level of productivity, like the U.S., could have a lower potential GDP growth rate when the year-on-year growth rate for the labor force and productivity gain year-on-year are increasing slowly.
The CBO recently revised the number slightly downwards to 1.8% and attributed 0.4% for labor force growth, and 1.4% for productivity growth. Next, we can find the reason from these two graphs. Both the labor force growth and productivity growth show a significant declining trend currently. Naturally, the potential GDP is declining as well.
Oh yes, the lower labor force growth is a result of population aging and low birth rate.
It can also explain why the potential GDP of Vietnam is so high currently. This is because Vietnam has a faster labor force growth rate in its demographic structure, and it is also improving its productivity from a low base by adopting new technology. It is very necessary to know that the real GDP grows around the potential GDP very closely. From this graph, we can observe two recessions historically. During the 1990s recession, real GDP dropped and then bounced back in a V-shape. During the financial crisis of 2007 to 2009, however, we had an L-shaped recession.
V-shaped. Economy recovers but activity permanently lost. U-shaped. GDP recovers, but slower than V-shape. Swoosh-shaped. Recovery is longer than V-shape, Faster than U-shape. Z-shaped. Spending surge fuels GDP above pre-crisis levels. W-shaped. Restrictions lifted too soon, more cases paralyze economy. L-shaped. Economy never fully recovers.
When a recession is L-shaped, it suggests that it is taking a long time to recover. Part of this is because the cause of the recession was not fully removed. For example, companies that fail are kept alive through a low interest rates environment and behave like zombie companies.
What's the recession shape in 2020 coronavirus pandemic?
Well, the shape depends on the Federal Reserve's and fiscal policy's response. Since we had a lot of Fed easing, huge government spending and sharp tax cuts, we saw a V-shaped recession rather than a U-shaped recession.
So, back to my initial question. You mentioned that the average real GDP is around 2%. Would it be better if it increased to 3%?
No, I don't think so. If we hit 3% when potential GDP is 1.8%, we are experiencing unsustainable growth. We will be using up more resources than we have, which will be inflationary. The rise in price pressure very likely pushes the Fed to raise interest rates. Bad for the stock market.
That makes sense. GDP sure is a big thing, and we have to think a lot about the growth or lack of growth impacting the financial markets. I appreciate your help.
No problem. Do you want those fries? I am still hungry and I'm getting thirsty now. There is a boba shop nearby. They take only cash and I have my credit cards only. Can we get?
No, not today. Thank you for watching.
This presentation on a framework for country investment, Part 4 is brought to you by the PJ Finance Show.